We're going to have a new Fed chair. Whoever replaces Lisa Cook will probably be an Uber dove. There's, add one more existing dove. That's 4 out of 7. So all of a sudden, the FOMC is stacked with doves. So that could mean that, hey, there are more cuts in 2026 than what Morgan Stanley is saying. But what does that do to the path of longer end yields? Well, I think it probably pushes them much higher. That would mean that if those doves are installed, as it looks like they probably will be, then I think the 10-year breaks out and heads higher. So that's something worth thinking about. Let me bring it back on over here to the video content.
And here's what that extreme scenario could look like. ING actually modeled it out. They call it a MAGA dovish scenario, and it involves deep, unjustified rate cuts that send short-term rates plunging, only to force a massive, sharp hike later on to clean up the mess.
So you guys remember the knob spread that I was talking about last week over here in the school community? Let me just scroll down and just take a look at that real quick. So the on-chain knob spread. So this trade would benefit most from that type of scenario where long end rates move higher faster than shorter end rates. So this is notes over bonds. And the moment that I find a product that allows me to get short at 30-year bonds, then all of a sudden we can trade the yield curve on chain. So I think that it makes more sense to trade the curve rather than trying to predict where a specific bond or note or bill is going to go up or down. It's easier to kind of sort of predict the direction of the curve, I think. So
ING itself calls this a potential toxic cocktail for the markets because it would risk seriously damaging the Federal Reserve's credibility. So, here's the crucial point. This whole debate over what the Fed might do, it's happening at the exact same time as a whole host of other policy wildcards are hitting the table. So let's just zoom out for a second.
I mean, beyond just the Fed, investors are trying to figure out a major Supreme Court ruling on tariffs. There are calls to massively increase the military budget, and you have new directives being issued in the housing market. Each one of these things just adds another layer of unpredictability.
And all of these things, in my opinion, are bearish for bonds. That means bullish for long end rates.
And hey, this isn't just a US thing. Just look at this chart of Germany's budget. It shows this huge shift in spending toward defense. It's a really clear, real-world example of how geopolitical priorities are changing all over the world.
The thing about Germany, though, is, look, you can spend all the money on defense in the world that you want, but if you don't have energy to build stuff, then it doesn't matter. So I was reading a note that was saying that in the Eurozone, they're going to have to start rebuilding their energy infrastructure if they want to have any hope in the world of being able to rebuild their defense infrastructure. So looks unlikely, especially when you are like shooting yourself in the foot by not resolving the war with Russia so that you can get that cheap natural gas. Where are they going to get the energy to rebuild? I don't know.
And that redirects massive amounts of money and creates entirely new dynamics for investors to deal with. And that brings us to the ultimate question, doesn't it? On one side, you have this powerful, roaring U.S. economy that's being driven by a very real productivity boom. On the other side, you've got an increasingly complex and unpredictable policy environment, both here and around the world. So, which force is going to win? The fundamental strength of the economy or the deep uncertainty of politics? That is the question that's going to decide where this market goes next.
Absolutely. Okay, so there's some interesting stuff here in the slide deck, but now that we've had a chance to go through that piece of video content, let's just take a look over here at BTC and ETH real quick. So now we know that the economy in the United States is actually roaring. Like if we're talking about Q4 GDP up near 5%, according to the Atlanta Fed, that's what a booming economy looks like. But, you don't have, there's always going to be risk. So when I take a look here at the S&P, breaking out to fresh all-time highs, and putting in a really nice looking bull hammer candle up here at the highs makes me think that this could continue to melt up, especially as volatility is muted. But here's the problem. We're just, for us as digital asset investors, we're not seeing any type of rotation from precious metals or any bond flows into digital assets at all. We're just not seeing it.